Welcome back to the program. We've come to the end of our series on understanding the trading of shares and what is needed to list your company on the stock exchange. We spoke to two legal advisors, founding and managing partner at Design Law Group, Rizwan Desai, and leading partner at Armstrong Attorneys, Sipho Ziga, on the importance of having legal advisors when you wish to list a company. We were also joined by CEO at Motswedi Securities, Martin Makhatle, explaining that SMEs need sponsoring brokers to help with their journey to going from private to public. In our last installment, the CEO of the Botswana Stock Exchange, Thapelo Tsheole, discussed Central Securities Depository as an institution that holds financial instruments, including equities, bonds, money market instruments, and mutual funds. Well, now that you know what you need to assemble a team to help you on this journey, how do you go about making that winning pitch to potential investors? Investors need a compelling story as to why they can trust you to bring them a good return on their investment, which is why effectively communicating your venture case to them is of utmost prominence. Portfolio manager at Murule Capital Partners, Wenyu Machacha, is on the program.
When a company actually gets to the IPO stage, they would have gone through probably months of preparation leading up to that moment, where they would have had to engage and interact with different service providers such as legal experts, corporate advisors, stockbrokers, etc. So I think, they would have done a lot of work in terms of helping them get their ducks in a row, so to speak, and putting together at the bare minimum the information that investors typically require in an IPO. So by the time you actually get an audience with potential investors, I think what is important at that stage as a potential investee company is to, be as transparent about your business as possible. Investors are going to ask a lot of questions about your business. They're going to want to know what your growth strategy is, what the market opportunity is, how are you going to position your business in the market to take advantage of those opportunities, and what your competitive advantage is. Why is it that consumers or customers are going to come to you instead of your competitors? What are the risks in terms of your business? Have you thought about what could go wrong, and if how are you going to manage those risks? So there's going to be a lot of engagement between that company and potential investors. All of these questions are really just designed to assist the investors in understanding your business a lot better. The more they understand about the business, the more comfortable they can become about the fundamentals of your business, and that sort of gets you one step closer to them actually making the decision to invest in your company. So I would say just be as transparent and open about your business, know the ins and outs. If you do that, you're actually getting one step closer to building confidence with your potential investors.
How can issuers attract investors and garner shareholder support on an ongoing basis?
That sort of assumes that, that particular company would have gone through the first round of raising funding from investors, right? So I think there are several things to consider. Once you've been successful in raising capital from the markets the first time around, your business is going to be under a microscope. So investors are going to be watching you very closely. So I think it's important that you use the next phase of your business as an opportunity to build a good track record in terms of allocating capital. Investors are going to be watching what it is that you're spending their money on, and whether those decisions are actually creating value for them or are they destroying value. So if you make terrible investments, for example, and you lose people's money, it's highly unlikely that the next time you come back to the market to try to raise funding, that people would be willing to provide you with further funding, right? So I think the second thing is this. It's important that companies use the funds that they raised during an IPO or fundraising exercise for the exact same purposes that they had advertised. Companies raise money for different reasons. It could be because they want to sort of pay off the debt that is on their balance sheet. It could be because they want to invest in more plant and machinery to expand their production capacity and scale the business. or it could be for research and development purposes. Whatever the case may be, it's important that once investors have trusted you with their funds, you use them for that exact same purpose. I think if, for example, you're in the business of property and, you know, as you are pitching, you tell investors that I need 10 million or 20 million so that I can buy more properties and increase the income of my business. It's important that you do exactly that. If you do a 180 and then go invest in the agricultural sector, for example, that's you risk losing credibility with your investors because you've gone and done something else that is different from what you had spoken to your investors in terms of what you intend to do. So it's important that your use of funds be exactly what you intended. And I think the last thing that is important is just to be transparent and open on an ongoing basis. What we tend to see sometimes is, you know, once a company has been successful in raising money from investors, they tend to be sort of cagey or not want to reveal certain information in terms of the operational aspects of their business to investors. You know, I think once you become a public listed entity, you have to accept the fact that, you know, your business is now a matter of public interest and that you may have to reveal more about your business than your competitors. It's just something that comes with being a listed company.
This program was brought to you in association with First National Bank of Botswana.
FNB, how can we help you?